Treasury yields traded higher today as we saw an early move to the downside, testing those lows, that low 260-ish level that we've been sort of revisiting in February, to seeing a quick reversal higher, not only exceeding yesterday's highs, but going beyond, hitting our highest mark in several days and looking like a technical turn, what we'll call the old outside day higher, so we trade lower than the previous day and higher than the previous day, but settle above the high mark from the previous day. So right now we're seeing a modest move back into the old range. The market did seem a little caught off guard here as sellers came in. There was obviously some investment grade bond deals going through. Likewise, there was some issues overseas between India and Pakistan, and you always have the ever growing what's happening in Washington, D.C. and China trade deals and whatnot that are hitting the tapes, and all that combined point us to higher yields. Still, the 10-year-old still remains below 270, a level it's been hasn't traded since the middle of February, and certainly hasn't seen a sustained trade there for quite some time. So, but we are now pushing up close to that 270 level. I think 275 might be the high trade in yield speak, but I don't know if we'll get there. I don't know if we'll have the sellers to push us that far, like with everything else that's happening right now around the world. But I think ultimately this move may cause that push towards the extreme low yield that we've seen a couple times this month to at least be put on hold for a while until some catalyst event pushes us back there. And if you look at market volatility, trading back into the old range has brought in lower volatility. So it is starting to push lower again. Kind of a sideways trade today with a lean towards the downside, but nothing significant. I would have thought that on the quickness of the move that we saw, the sellers that came in, we may have seen a bit of volatility. We did not. So I think that right now volatility is suggesting that we are going to remain inside that range, what we'll call the macro range, which is really 260 to 280, but has been much narrower over the last month or so. It's been more like 260 to 270, and we are still within that range. So market volatility not a factor today as it continues to hold steady to moderately lower. And lastly, let's talk about the Fed and what's happening ahead. Yes, we had Mr. Powell speak this week. No real surprises when he talks about the economy, when he talks about what the Fed's ideally would like to do. But I think that right now a few points that he touched upon were the balance sheet. He was asked specifically about the balance sheet. Fed will give us a more detailed balance sheet plan, likely at either March FOMC or at some later date. But right now it seems that they're going to be very comfortable running with a much more elevated balance sheet than perhaps we would have seen. Recall, before the crisis, we were sitting at a balance sheet below $1 trillion. Now we're somewhere north of $4 trillion, and we were expecting the withdrawal to take us down somewhere closer to $1 billion, and that doesn't seem to be the case. And I think ultimately right now the Fed's going to sit and wait. They do not want to make any sharp, quick moves in an economy that is starting to struggle. If you look at some of the data, whether it be home, whether it be factory numbers, that are really starting to struggle. And I think that ultimately, if you look at that GDP number, which we're going to get the advanced GDP for fourth quarter tomorrow, we could be looking at the lowest GDP since Trump's first full quarter in office back in Q1 2017. So I think that right now is going to be of concern to the Fed, along with, we've got Brexit coming up, and we've got budget issues in Washington, and we've got deficits running well above where anyone expected them ever to be. And I think that the idea that the Fed will continue to provide support to the stock market by keeping policies very easy and using quantitative easing or traditional easing and using the rates, I think that those two things will probably remain in play, which is one of the reasons why I think you haven't seen the equity markets collapse, is they are waiting for the Fed to at least step in if anything goes bad or goes south. So right now Treasury yield seeing a big reversal today, but I doubt we see an extension of that as we head into the weekend. But look for Friday's number to probably dictate that, and if it comes in on the low side, look for those yields to creep back down to the lows before too long.